Welcome back to the Money Loop, the channel where we break down money markets and investing concepts in the simplest way possible. Today, we're talking about something that surprises a lot of investors the first time they experience it. Sometimes diversification fails. You can own stocks across different sectors, different countries, different industries, and somehow everything still falls at the same time. So what's going on? Why do diversified portfolios sometimes crash together during major market panics? And does diversification even work if that can happen? Let's make this actually make sense. Normally, diversification works because different assets react differently to different situations. Some industries perform well while others struggle. Some assets rise when others fall. That's the whole idea. By combining investments that behave differently, investors try to reduce overall portfolio risk, and most of the time that works pretty well. A diversified portfolio is usually much less volatile than putting all your money into one company or one sector. But there's one huge problem. During major financial crises, relationships between assets can suddenly change. This is one of the most important ideas in investing. During market panic, correlations often moved toward one. In simple terms, assets that normally behave differently suddenly start moving together. Why? Because fear changes investor behavior. When investors panic, they often sell everything at once. Not just risky asset, not just weak companies, everything. Stocks, crypto, real estate funds, emerging markets, growth companies. Money floods out of markets broadly as investors rush towards safety and liquidity. And that's when diversification can temporarily stop working the way investors expect. A classic example is the 2008 financial crisis. Before the crash, many investors believed that they were properly diversified. They owned different sectors, different banks, different asset classes. But when the crisis hit, global markets became heavily correlated. Stocks across the world fell together, banks collapsed together, real estate crashed, credit markets froze. Why? Because the entire financial system was under stress at the same time. When systematic risk appears, diversification becomes much less powerful in the short term. It doesn't fully protect you from broad market fear. There's another important reason diversification can fail during crises: liquidity. When investors desperately need cash, they often sell whatever they can sell quickly. Even good investments get dumped simply because investors need money fast. This creates a chain reaction. Falling prices create more fear. More fear creates more selling, and more selling increases correlations across markets. It becomes less about fundamentals and more about survival and panic. So does this mean diversification doesn't work? Not at all. This is the important distinction. Diversification reduces risk. It does not eliminate risk. A diversified portfolio may still fall during a major crisis, but usually much less than concentrated portfolios. For example, a portfolio built entirely around speculative tech stocks may collapse far harder than a balanced portfolio containing bonds, defensive sectors, and international exposure. Diversification is designed to improve long-term survival, not to make you immune from every market crash. The real lesson learned is that diversification works differently in normal times versus crisis periods. In normal markets, different assets often behave independently, but during extreme fear, investor psychology can overwhelm those differences temporarily. That's why experienced investors focus not only on diversification, but also on position sizing, liquidity, time horizon, and risk management, because surviving market crashes is just as important as growing wealth. So hopefully this explains why diversification sometimes appears to fail during market crises. Correlations rise, fear spreads, and investors start selling everything together. But diversification still matters enormously over the long run because it helps reduce unnecessary concentration risk. If you enjoyed this video, subscribe to the Money Loop for more simple explanations of investing, markets, and finance concepts. And I'll see you in the next one.